If you're trading call credit spreads and not sure what to do or what can happen near expiration date on your spreads, this video is for you. Call credit spreads are an excellent option strategy to generate income, and it's exciting to jump into them, but it is critical to understand all the risks that come along with it. So let's take a look. Alright friends, so let's talk about call credit spreads. Remember, these are options contracts we are dealing with. These are agreements between a buyer and a seller that must be fulfilled. So remember, an options contract is the equivalent of 100 shares. An options buyer has the right to exercise to purchase shares. So if they buy a call option, they can purchase the shares. An option seller, on the other hand, has the obligation to sell the shares to the buyer in the event that the buyer wants to purchase the shares. So we need to know those basics. If you know those basics, you are good to go. Now we can move on to the call credit spread here. And before I move on any further, it is important to note that the content in this video is not a recommendation to buy or sell any securities and is for educational purposes only. And guys, if you find any of this information helpful, please don't forget to tap the like button. That helps me out a ton and it is greatly appreciated. So the first important basic information to know is the structure of the call credit spread. And well, before we even get to the call credit spread, you need to know what options contracts are. If you don't know that, you shouldn't be touching this stuff. So we are going to use an example of purchasing a long call option at a strike price of $80 and then short the 75 call option for a difference of $5. So because an options contract is worth 100 shares, we take that and multiply it by 5, which defines our risk of $500. Now we can finally jump into the part you've been waiting for. The 3 different scenarios that can play out when trading call credit spreads. These are some of the most common scenarios that can play out, and I'm going to clear that confusion up for you. So if you're not sure what a call option is, or if you're lost by now, please rewind back to what I said earlier and study the chart. It'll help clear up any confusion you may have. Learning this all at first in the beginning can be tricky, so I understand where you're coming from. And I get it. We've all been there before. We all have to start somewhere, right? So it's all good. Now let's jump into the first scenario here. I have my Thinkorswim pulled up to have a visualization of the chart. I chose a stock here, AMD, and we're going to look at a scenario here where the stock goes up to, let's say, $90 off the chart off expiration, right? So you will have to exercise your call and acquire the shares. Then the short call that you have will be assigned. You will require to be selling your shares from exercising your call option. And then you exercise the $80 call, right? So you do that. That's going to give you the 100 shares, which will cost you about $8,000, right? 80 times 100 gives you 8,000. And then for the 75 short call assignment, you will take the same 100 shares purchased and sell for 7,500. So this is how you come up with the loss of $500 that is realized on the trade, which was the risk that you defined to take on at the beginning of the trade. So remember the difference of the strikes as your defined risk, and don't forget to include the premium paid for taking this trade. For this trade, we received a credit of $1.50 because the long calls were going for $0.50 and the premium received from the short calls was $2. Therefore, you take the $2 minus the 50 cents. That will give you $1.50, which would be $150 received. So your net loss on this trade actually is you take the $500 minus the $150 received of premium, and your net loss is $350. This means that this will be the case for any price above the long call strike price at expiration. And so this scenario is pretty straightforward. It's easy. You don't want the stock to go above your long call, because your long call is going to offset the losses from the short calls because you define the risk. That is the key to remember here. Now for the second scenario. Let's say the stock rises but closes below your long call, so it doesn't jump into the red territory that we jumped in on the first scenario, and it doesn't go below this green line. It hangs out somewhere in between here. Pay attention very carefully. This one trips many new option traders up. So we won't be able to exercise those $80 calls, meaning they're worthless at zero because the stock is not trading above 80. And it's trading below that $80 long call option. So if the stock is trading above, let's say, like at about $78 instead, this means your short $75 call will get exercised. So you'll have to sell 100 shares at $75, which is required. Therefore, to close out that short position, you will have to purchase 100 shares at 78, where the stock would be sitting in this scenario, and that will cost you $7,800 for those 100 shares. This means that 7,800 minus the 7,500, right, results in a loss of $300 loss on the trade. But don't forget, you collected the $1.50 in premium, which equates to $150 for the option trade. Therefore, take the $300 minus the $150 from the premium collected, and your net loss is only $150 on this trade. So the most important part about this scenario is that the long call becomes worthless. So you need to make sure to purchase the 100 shares to offset and close the short call that you have at 75. That is all. Lastly, we have the scenario where the stock goes down, it drops, closes, let's say below at $73 on expiration. So it ends up in the, below the green line here. And this is the best scenario and the outcome you will want every time. You won't be able to exercise the $80 call because it's out of the money and worthless, right? It's not above in this red area. And you won't be exercised on the 75 short call either because it's out of the money. It's worthless. It's not in this area in between the red and the green. So, therefore, both options expire worthless and no stock is bought or sold, meaning you get to keep the $150 premium collected from the trade, and that's all there is to it. So the main keys of credit spreads and why they're favorable tools is you define the risk. It also provides flexibility, whereas you can, let's say you collect the premium and you still have time on the options contract and you're up significantly on it, you can close out the short, keep the long call that's worthless since it has a lot of time, and who knows if that stock rebounds. There's been scenarios, very wild scenarios where that happens, and you get to win on both sides of the trade. So that's a little bit more advanced, but that's kind of the cool flexibility with it. And also, you're limiting your risk rather than selling naked options. Naked options carry unlimited risk when you are selling calls to, let's say the stock goes on a squeeze to the upside. It could keep going and going and going, and well, you end up in a very deep hole. You don't want to be there. Don't do that unless you are a professional. And really, the main disadvantage here with this strategy is that you are limiting the profit potential because, again, you are defining this window here, the amount of risk, whereas if you buy a single call or sell a single call, the potential to gain is higher, but comes with that higher degree of risk that I just said before. So guys, if you found this helpful, please make sure to share with a friend. Not knowing these three scenarios, how they can play out and how they can work, can cost you a good amount of money. Please be safe out there. Do your due diligence. And if you have any questions, please feel free to reach out to me in the comments or send me a message on Instagram. I'm at Trade Study on there, and you'll see me in the next one.